Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
So if you're a small business owner, you know this feeling, right? You're trying to figure out your taxes, but you're also staring down this mountain of college costs for your kids. And it always seems like the moment those tuition bills start rolling in, those child tax credits you've been relying on just disappear. So the big question is, can you actually use your business to help solve both problems? Can you save your family thousands of dollars in a smart, legal way? Well, let's find out.
Okay, let's dive right in. Here's the game plan for today. We're going to start with the core problem that so many of you face. Then, we'll unpack a really powerful strategy that revolves around hiring your kids. From there, we'll tackle the big one, paying for tuition directly from the business. We'll compare the two key IRS programs you need to know about and wrap it all up with a clear, step-by-step action plan you can actually use.
This is the real bind, isn't it? On one hand, your expenses are just exploding with college tuition, but on the other, your tax breaks are shrinking. It can feel like you're caught in a financial vice, and it leads a lot of business owners to wonder if there's a creative and totally legitimate way to use the business itself to ease some of that pressure.
And that really all boils down to this one massive question. Can I actually take that enormous tuition bill and turn it into a deductible business expense? Well, the short answer is, it's complicated. But the good news is, in many cases, the answer is yes. You just have to know how to do it right.
All right, so where do we even begin? Well, before we jump straight into paying tuition, there's a foundational strategy that pretty much every family business ought to consider. And that's putting your kids on the payroll. This is often the simplest, most direct way to start shifting income and cutting down your overall tax bill.
To make this all make sense, let's use an example. Let's meet the Hong Gildung family. They run a great little business, and after all their expenses, they're left with a net income of $100,000. So that's the number the IRS is going to be looking at for taxes before we do anything. So here's their first move. The family business hires their two children to do real, legitimate work. We're talking social media, filing, cleaning the office, whatever it is. They pay each of them a salary of $13,000 for the year. And as you're about to see, that $13,000 figure is not random at all. It's very strategic. And bam! Look at what happens immediately. The business now has $26,000 in new, legitimate salary expenses. So that $100,000 profit, it instantly drops down to just $74,000. That is a huge chunk of taxable income that just vanished.
Okay, great for the business. But what about the kids? Don't they have to pay taxes now? Nope. And here's the magic. Since each of them earned $13,000, they can use their own standard deduction for a single person to completely wipe out that income. The bottom line, their taxable income is zero. They don't know a dime.
So let's just step back and look at the big picture here. The family is still using that $26,000 for the kids' expenses. You know, car, food, college savings, just like they would have anyway. But by structuring it as a salary for real work, instead of just an allowance, they've effectively made $26,000 of their family income completely tax-free.
Now, the income tax savings are fantastic. But believe it or not, that might not even be the best part. For many small businesses, there's another huge layer of savings you can get on top of that, the self-employment tax.
Okay, so here's how this works. It's a game changer, but you have to fit the criteria. If your business is a sole proprietorship or a certain kind of LLC, and your child is under 17, the wages you pay them are completely exempt from that huge 15.3% Social Security and Medicare tax. That is a massive bonus. Now, if your child is 18 or older, don't worry. You still get all those awesome income tax benefits we just talked about. This is just an extra cherry on top for the younger kids.
Okay, so hiring your kids is a powerful tool. A total no-brainer, really. But now, let's get back to that bigger, more ambitious question from the beginning. Can the business directly pay for college tuition and write it off?
The good news is the IRS does have established programs that let businesses pay for their employees' education. And your child, as a legitimate employee, can qualify. But, and this is a really big but, there are too many ways to do it, and they have very, very different rules. Picking the wrong one can get your entire deduction thrown out, so you absolutely have to know the difference.
So let's put these two programs right next to each other. This is really where the details matter if you want to stay on the right side of the IRS.
Okay, check this out. At first glance, that top one, the working condition fringe benefit, looks amazing, doesn't it? No dollar limit, but here's the catch. It's a big one.
The education has to be for skills needed in the employee's current job. And the IRS has ruled over and over that a general college degree doesn't qualify. That's why we're going to focus on the second one, the Section 127 plan. This is the one that's actually designed to work for college tuition.
This is the magic number you need to remember, $5,250. Under a Section 127 plan, your business can provide up to this amount per year per employee for education. And here's the double win. It's 100% deductible for the business, and it's received completely tax-free by your child. It is a perfect tax scenario.
Now, you know the IRS isn't going to leave a benefit this good without a few rules, right? They've put up some guardrails. To use this awesome benefit for your own child, they have to hit 3 checkpoints. They need to be at least 21 years old, they cannot be claimed as your dependent on your tax return, and they can't be a major owner of the business. If you check all 3 of those boxes, you are good to go.
Okay, so we've got the hiring strategy, we've got the tuition payment plan. How do we make them work together to get the absolute maximum benefit? Let's build our action plan.
But first, we have to talk about a super important tax principle. No double dipping. The IRS is really clear about this. You can't use the exact same dollar you spent to get 2 different tax breaks. So you can't pay for tuition, deduct it as a business expense, and also claim a personal tax credit for that very same payment. But that doesn't mean we can't be strategic.
And this is how you legally stack your benefits. It's beautiful. Here's the play. Step 1, your company pays that first $5,250 of tuition under its Section 127 plan. That's your business deduction. Then, for all the tuition costs above that amount, the part you're paying personally, you can still go after personal education credits like the American Opportunity Tax Credit on that remaining balance. See what we did there? You're not double dipping. You're strategically using 2 different benefits for 2 different parts of the bill.
And that quote just nails it. This isn't about replacing the tax strategies you already use. This is about taking the credits you already know about and then leveraging your family business to add a powerful new layer of tax savings right on top. It's an and, not an or.
So there you have it. We've seen how hiring your child and using an educational assistance plan can create some really significant tax savings for your family. And that leaves us with one final thought, one last question for you to think about. Is your business structured in a way that lets you take full advantage of these strategies? Because having the right business structure, that's the foundation that unlocks these powerful financial tools. Thanks for joining me.